So, welcome to the very first episode of Metrics That Matter. We're really excited today to have Oliver Gellis, the CMO of OrthoFi, Chris Bentson, partner at Bentson Copple Associates, and Shannon Patterson, also a partner at Bentson Copple Associates, BCNA. We, the four of us, I get the privilege of sitting every quarter with these brilliant minds and discussing the data in the industry and just, doing a run through of, what should practices be looking at? What's the data showing? What are the numbers looking like for this quarter and beyond? And we have just a rip-roaring good time every quarter talking about these metrics. And we really thought we might just kind of invite you into our living room and let you hear just how these conversations go and what we're seeing, what we think you need to be watching for, and just have a real good time talking about the data. Oliver, I thought it would be great for you to kind of give an orientation of our thought behind the Metrics That Matter series. And so I'll let you take it away.
Yeah, thanks. The genesis of Metrics That Matter really was sparked by, me sitting in the audience and listening to, Chris and all the data that Chris and Shannon prepared for Chris's recent lecture at our Nexus meeting. And he shared so many great metrics and great data. And I think people are hungry for it. And with all of the uncertainty going on in the economy that we'll talk about, I think it's more important than ever that we check in more often than just maybe an annual, listen. So many things have gone on that we'll talk about today. And so, we're always chatting in the hallways and margins about data and how the economy's doing and the impact on starts. And like you said, Marla, we thought it was great value for people just to be flies on the wall for some of this. So the first, thing that I had was, again, just referring to the Nexus lecture and how dense that was with great information. You mentioned, Chris, and it stuck with me, your projection for 2023, just a month and change ago. You mentioned that your expectations and projections were that we would see likely a tight or a tough first three quarters in 2023, and then a loosening and a surge in Q4 that would extend likely through 24 and 25. How do you feel about that today, after another month and a half of starts and data and results? How does that feel to you today?
Yeah, the same, except maybe the road's a little bit longer, the trip's a little bit longer. So, the good news is we had really good January. We had an okay February, and then things really decelerated in March. And so when you look at a lot of the data that I share from Gauge, and you look at just Q1 that we ended, 10 days ago or 4 days ago, production for the quarter for that data set was up versus the same quarter in 22 by 3.45%. A little bit surprising for me, stronger than I thought. Collections were up by 1.85%. And if you remember in that lecture, we talked about we were flat on collections at the end of last year, but down 6.5%, 7%. So I was predicting that, December 31st of this year, 2023, you'd be down by 5 or 6% in cash. But right now we're actually up compared to the same time period. Don't get too excited because I don't think it stays this way. And starts were up a very anemic 0.55%. So good January, medium February, not so good March is kind of so the velocity was not great. So I think, this banking noise that we all heard about with Silicon Valley Bank and a few other regional banks caused the Fed not to go as strong in an interest rate uptick as maybe they wanted. They wanted 50 basis points. They only did 25. I think we got a couple of more of those coming in, and that's going to stretch out to the end of the year. So everybody that I listen to now says where we used to think just a month ago, we might see the top of the interest rate rise and actually interest rate reductions in the fourth quarter. Now we're kind of seeing maybe the last rise will be 25 points. It'll be the beginning of the fourth quarter, and it won't be till 24 until those start to decrease. So I think it's largely the same, Oliver, as what I was thinking, but maybe we don't bounce out of it as strongly in Q4 as I anticipated, and it goes into 24 and 25. But it doesn't change my mind that you ought to be thinking about and investing on, what you need to do in your practices to be ready for this really good bounce back, and it's going to come.
Yeah, we had the same outlook, a lot of the same types of results. We saw that same strong January, over 7% growth in January, then going between 2 and 3, and then actually dipping below prior year in March. So that trend line going down, kind of confirming that we'll likely see some tightness and toughness there. So we saw a lot of the same things with the 1,000+ locations in our data set, which is largely complementary to Gage, and we're always thankful to Gage for providing their data as well. It's a great value for the industry. So we saw a lot of the same things. And so, so in terms of the banking crisis, do you think that is a real impact to consumers, or is it just one of those consumer confidence dents that just takes time, for people to get over and work its way out?
Well, it was a surprise. So yeah, I think it had a short-term effect for sure. And that was kind of freezing consumers a little bit about what's going on. Are my deposits okay? Is this going to be a repeat of something we've seen before in 2008? Clearly that danger is gone and that fear subsided. But long-term, is it going to have some effects in the orthodontic world? I think so, because nobody wants this to happen as a surprise again. No one was predicting it, and it did happen. And so what are they going to do to prevent it? They're going to tighten the rules on credit for these, mid-level regional banks. And ultimately that's going to creep into the consumer, where things are going to cost more. It's going to be harder to borrow. It's going to be harder to do things. And I think that will have probably a longer-term negative impact on orthodontic consumer confidence, where they feel good about spending money because everything else is going to be tighter and more expensive for them.
Yeah, absolutely. Absolutely. And then Shannon, I think you were mentioning some stats around consumer purchasing index, consumer confidence. Anything you wanted to add?
Sure. I mean, I think we have seen the consumer confidence index slide a little bit. The banking situation did not help that. But something that we monitor pretty closely is just indicative trade down behaviors of the consumer. We definitely see the mindset of the consumers. The word budget is back. They're looking at, more value oriented retailers, things like that. So it's just something to keep an eye on. But, the consumer has, consistently kind of defied everything, and we've still had growth each quarter. I think this next quarter is going to, show if we see a difference in that.
That's great. So in that vein, I've asked you this before, and I certainly don't want you to feel like you have to share any secret sauce, but you guys do such a great job of not only looking at the industry metrics, but also the market, macroeconomic market at large. Are there, pet metrics that you guys rely on, that you triangulate to generate your projections beyond, kind of what we've talked about today, that you would share?
I do. I always look at, everyone gets caught up on the CPI. I think that varies on state levels, but I always look at the consumer confidence index. I think that's a good indicator of just where people's mindsets are. I also look at the purchases of durable goods. That's a good indicator for small business owners to look at. Are people spending money? Are they making bigger purchases? Those kind of things. So those are some things that I use, and Chris, I'll let you jump in on that as well.
When we value practices, we're kind of constrained by, what are the real published data on, risk values for small business owners as they trade, and those have gone up. It's more expensive to borrow money right now than it used to be. We believe that, that's a new event. And I think, Shannon, you might even throw a story in of something you heard recently about, what interest rates are doing to purchase, to buyers who are considering purchasing practices, because even though they get great rates, they're quite a bit higher than they were just, 6 months ago. So, we look at interest rates, we look at inflation, and I think consumer confidence, and how is the family with 2.3 kids being able to manage versus the rest of the world, because that's our consumer. And I think still they take it on the chin harder than everybody else. So I'm still a little bit bearish on this year. Yeah, we did have a decent first quarter. I'm not too surprised about it because January seasonally is such a good month for us in ortho. But I don't see a super good second and third quarter. And I think I was predicting this, fairly positive bounce back in Q4, kind of maybe dead even from last year. And then we start to climb out as the United States economy into much better territory. So for me, it's still time to invest.
Yeah, that's a great insight. So, the whole, as we always say about data, data's data. It's the what you do about it and what's the insight from the data. And so just to kind of switch gears a little bit, what are a few things that, in addition to monitoring some of these metrics, that practice owners should be thinking about? Any particular metrics in their practices that they should be looking at more closely, and obviously any strategies that you guys recommend to deal with what we're talking about?
You go first, Shannon, and then I'll jump in.
Yeah, I think that's a great question. So something I always look at is the recall bucket. I've seen that kind of take a dip. I don't think we got that number from Gauge, but I think that the recall buckets are going to be worked differently this year. I think that TCs need to have some language around people that are in OBS and recall and having definitely more engagements with them versus having them come in every 6 or 12 months for a checkup, but to consider virtual options as an engagement tool, not necessarily to do a virtual new patient exam, but to definitely check in. I think that a lot of times that's looked at as a less than inferior option to have a virtual check-in, but I think that it's going to make a lot of sense in the coming months, just again, to have more engagement. There are going to be practices that, are going to slash prices $1,000 off. And we certainly don't want anybody to cut their prices, but, to be prepared if someone does that, to definitely have more engaged marketing and have more engagement with the patients that have been through your door. We could see some shopping behaviors return, just again, because we're seeing that indicative trade down behavior in the consumer market. So just be prepared, your TCs be prepared for that, to understand that it might be more challenging. And again, just more touches and more wins that you can have, and definitely being educational in that new patient exam on why, it's still important to come to those appointments and start dates and those kind of things.
Yeah, and I said, we shared some data at Nexus on just, the adult patients fell off last year. We did a little bit analysis, Doug Copple from our team did, on, what did that bounce back look like? And there's been a little bit of published data in the 2008 crisis, and it's not linear. They don't all of a sudden all bounce back. So I think we're in for a long haul bounce back. So, we looked at that consumer, indices of, what's so important to the consumer. Convenience and efficiency are two things. And so the adult can learn that when they come for the new patient exam. But if they don't know that before they come, maybe they drop out and either don't even try, or they make an appointment and they're hot and it's a little bit too long before they get in. And those are where a lot of our no-shows are coming from. So I think every practice has an opportunity to change the way they identify and project with those issues. And improve them. We can talk on the phone, we can do it through our socials, we can do it on our websites and things like that. But I think we have to message to the consumer base, especially adults. We are flexible with payments. We understand it's hard. We are efficient. You don't have to come in like you did when you had braces when you were 12. It's different. Much fewer visits. Maybe, as Shannon suggested, we have this virtual overlay where we can handle some appointments like that. But that needs to be communicated sooner and upfront, so the consumer knows as they're making that new patient exam that those are options that exist today. I think, two things I would pitch back to you, and you had the best data on it, Oliver, are, we're all worried about delinquency. I don't see it going up a lot in the valuations we do, and I think that's because so many people are on what OrthoBank really revolutionized the orthodontic specialty in is, let's get these automated, and pretty much every practice management system, and certainly OrthoFi has. So I'd be interested in your data on delinquencies. And then I think also, what are you seeing, if anything, in your data on fee flexibility? I would give the specialty an A in that over the last, 10 years, really. We've gone from 25% down in 20, months or 18 months to, you can really do a lot of different things. But is your data showing anything on fee flexibility? Because I think the consumer wants to see that.
I think what's really encouraging that we see is that it's relatively stable when it comes to delinquency and collection rate. We definitely can feel the risk notching up. Part of it is because we started some patients during the stimulus time that probably wouldn't otherwise been able to afford it. And so there's a pocket of patients that we're sort of waiting intently to see if the other shoe drops, but so far so good. And, the other thing we see is that, with consistent processes, the insurance collections are still very, very stable. We've seen slight uptick. We do sense that the carriers are trying to pay a little slower, but we counter that with regular and consistent outreach. So we're able to see it. I love some of the things you're saying, though. I mean, the way that I would summarize, what we're seeing and what we're advocating is, we showed some really good data about booking windows. So you mentioned if a consumer, especially an adult, has to wait, time, you not only have general human behavior that we've documented for over almost 10 years about this, but it's actually more acute now, because if you think about, the economy, the more time that goes by, the more chance that something happens financially for a patient or a family that will pause their decision. So what I would advocate is to seize the day, carpe diem, every diem, in terms of, getting people into the funnel, and then all the things you were talking about in terms of pre-informing them, we call persuasion, and that's at a premium now, again, especially into adults. In terms of flexibility, all the things that we've always been talking about and preaching are more important, although we have not seen plans get meaningfully longer over the last few months. The fact that they can creates like an absorbency, right? So if the economy tightens up, if you have open choice and flexibility, you're going to be able to absorb it without actually dropping in starts and creating barriers, for patients. In terms of like the competition with, consumer stuff that you were talking about, Shannon, what we're advocating is not so much, being more open to discount on the comprehensive fees, but adding a variety of offerings, right? Mm-hmm. So if the competition is coming with, well, I can get, for $2,500 a treatment with Smile Direct Club, the answer is, well, if that's all you want, if that's the level that you want, we can deliver something comparable for a very comparable fee. Only with us, you're going to get expert management clinically and diagnosis and things that you can't get that way. And so by adding an offering that is more apples to apples, you're creating less pressure to have to compete with your full fee. Does that make sense? I mean, I'm actually curious, like, we talked a lot about that at Nexus. Does that make sense to both of you?
Mm-hmm. Yeah, it does to me. I mean, I think both the Gauge database and the OrthoFi and OrthoBank databases are probably outperforming the rest of the market by some degree because they have some control in there. And, so part of the message to the orthodontic world is, if you haven't done that fully yet, you need to go into the deeper water with whatever option you feel like is best for you. And I think that's important.
Yeah. Well, I think this has been a great session. I love getting with you guys every quarter and talking through some of this. What I'm hearing today is that we really need to make sure we are mastering the virtual starts, that we are showing up for adults and meeting them where they want to be met. We need to look at doctorless exams, which may create more capacity, more exam capacity, because the booking window is a very important factor. And I'm also hearing limited treatment. So it's important that we're looking at limited treatment options. Fortunately, we prepared a lot through our Nexus event, and there were a lot of great presentations at Nexus about some of these very topics. And we have recently turned them into, Chris and Shannon, I'm sure that you've seen some of these, a series of webinars called Expert Insights. And we have those, some of them are available as recordings now, but we also will have more presentations in the future. So if you're just beginning to get in on this conversation about the metrics that we're seeing this year and looking at toward the future, be sure to join some of our industry Expert Insights series webinars. We'd love to have you join us for that. And we will see you guys again